to the co-founder of Home Depot slamming and calling out Joe Biden and the Federal Reserve. Let's go ahead and play this because it's pretty in-depth. Before I do, quick reminder that you can now use Buy Now, Pay Later to check out on the programs of Building Your Wealth, link down below. Briefly extended that coupon so you could use Buy Now, Pay Later services to build your wealth. Check out especially that Zero to Millionaire Real Estate Investing course and Stocks and Psychology of Money. All right, let's now get into this piece. Here we go.
Democrat Senator Elizabeth Warren went at it yesterday, clashing on Capitol Hill. Warren is slamming the Fed's inflation strategy, claiming that it will get people fired. Watch.
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. And we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it.
Will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Jeremy, right?
Yeah, it's worth noting before we get to the response of the Home Depot co-founder that is actually exactly what Jerome Powell's argument is, that yes, there will be pain going through this tightening process and you should prepare for it. But some job loss is better than a lot of job loss. It's basically the argument Jerome Powell is making. You know, Elizabeth Warren, they didn't show it all here. She made a fantastic historical comparison, suggesting that when the unemployment rate rises 1%, it generally goes on to raise another 1%. So in other words, we're at about 3.4, 3.5% unemployment right now. The Fed is projecting that's going to rise to 4.5%, which actually means they're telegraphing it's probably going to go up 2% to 5.5%. Which means potentially as many as 3 million job losses. Yikes. Let's listen to the response, though, from the co-founder of Home Depot, because he has some choice things to say. Let's go.
Right now, to look at the economy, the macro story, is the co-founder of Home Depot, Ken Langone, is here. Ken, it's great to see you. Welcome back to the show.
Hi, Maria, how are you? Thanks for having me.
I'm doing well, and I hope you are too. I want to get your take on the current business environment under the Biden administration. Ken, you've got investments in a whole host of industries and have a great vantage point to tell us what you're seeing on the macro story. How do you assess?
Well, first of all, Maria, I would classify the Fed as a gang that can't shoot straight. This goes back more than 18 months. When they were saying that inflation was transitory, and smarter people than them, namely Stan Druckenmiller and people like Stan, were all saying the exact opposite. So they got started late on the fight against inflation, and now, frankly, they act like the gang that can't shoot straight, because we should keep raising rates until we break it. Now, it's going to be some pain. Senator Warren, she talks out of both sides of her mouth. What she doesn't realize is the people who pay the most for inflation are the lower income people. Inflation is the most regressive of all taxes ever. We don't like paying higher prices, but we can afford to pay higher prices. Nothing changes in our life. But a family of four living from paycheck to paycheck has to start asking the questions, do I go with meat or do I go with a substitute? And on and on and on, because these people are really being impacted. There's no simple way to snap the back of inflation. The Fed needs to be more aggressive and needs to be determined to make it happen.
Wow.
My problem with the Fed overall is there's too many academics in the mix. I think if you had more business people involved or people with business backgrounds, I think you might see a different dialogue and different decisions.
Yeah, that's a great point. Yeah.
For sure, Maria.
Yeah.
We would have raised rates a lot sooner, a lot higher, to get a control of inflation. It's now out of control.
Yeah.
And I think, frankly, I don't know how you avert a serious financial crisis where we are right now.
Yeah.
I don't have any idea how you do it.
Well,
and now it's a more distinct possibility.
Well, there's also this issue around wages and this tight employment market, right? I mean, what are you seeing in terms of jobs? Because Jay Powell yesterday called the labor market, quote, extremely tight. Ken, this morning we get news that President Biden is proposing a 5.2% raise for federal employees in his budget. So the budget's going to be out tomorrow. And, you know, going into it, they're leaking the story that he's going to propose a raise for federal employees, the largest salary boost, Ken, in 43 years. So if you're raising wages right now, what does that do for the tight market that we're already suffering under? I mean, don't get me wrong. It's good that employees have seen their wages go up. But it's a problem for businesses. Look at Home Depot just recently saying they have to spend $1 billion because of this tight labor market.
Yeah, and keep in mind the people getting wage increases right now. And by the way, let me know if this audio is any better or worse. The people getting wage increases right now are generally the people working under about $20 an hour, which actually lowers your average wage, since the average wage in America is about $32. But yeah, wages have gone up across the board. I mean, just yesterday, the Wall Street Journal was reporting on how much wages have gone up at construction jobs. Wages rising substantially at construction jobs across the industry. Massive demand for construction. Specifically, you're seeing the individual workers seeing massive wage increases from, in some cases, specialized contractors seeing their wages go from $35 an hour to potentially as high as $45 or $50 an hour. So massive wage increases. Now, fortunately, there's been a massive increase in available labor supply that's helped. That's been evidenced by what we've seen at companies like Uber, Lyft, McDonald's, Chipotle. But the construction industry, for example, is looking to hire an additional 500,000 workers just to get back to normal pace in 2023. So there's still massive demand for workers. And so you are still seeing some inflationary pressures. And that is going to keep some of these services inflation somewhat sticky. Now, the Home Depot co-founder here is suggesting, hey, we need to increase how much we tighten the noose basically on the market to contain this inflation, because average working people can't afford this stuff anymore. Hourly wages for general construction workers are up 42% from 2019 to today. That's incredible. Absolutely incredible. All right, let's keep going here.
Well, we want to make sure our people are taken care of. Maria, to me, the first obligation you have in business is taking care of your people and make sure they're treated fairly and make sure they're living in a way that they're comfortable. We made that decision. I wish I was there to be part of it, but I'm retired. But thank God the company under Ted Decker's leadership made the decision. We have to do something for our people. So we by the way, we did it all at once.
Yeah.
We did it at the end of January. It's $1 billion. It's a lot of money, but our people need it. And with Biden, let me say this to you about Joe Biden, in my opinion, and I'm going to be very, very direct. He thinks he's the smartest guy in the room. If that's the case, we're really in trouble, because the American people are a lot smarter than that, and they see it.
Yeah.
And I'm afraid, Maria, the American people need to understand there's no pain, no gain. Maybe we're going to put 2 million people out of work, but I don't know any way around dealing with the problem of inflation and the tragedy of what comes with inflation. As I say, the poor people, the little people, the people living from paycheck to paycheck, they're the ones that get hurt the most.
Yeah. Which
And
is
we got
why,
to think about them.
which is
So-
why umpteen times you've said in the past, I don't need Social Security. I don't need these checks. Do something about it. Try to make sure Social Security is solvent. It's about to go insolvent in 10 years, and yet there's no plan to fix it. We're waiting on the president's budget tomorrow, and we're also waiting for this debt showdown to take place, right? The debt ceiling has to go up at this point. We have to pay our bills, but will they come up with any boundaries to spending, Ken?
No, what they'll do is they're already talking about raising rates. Look, Maria, I've said since the day I got a Social Security check, this is outrageous. I did so well in this system. I did so well under capitalism. It would be a travesty for Elaine and me to take any money from the government, any at all. And very frankly, what we do is we give those checks to charity every month.
Nice.
Why? Because if you try to give it back to the government, forget it. And if you gave it back to them, they'd only burn it more.
Yeah.
But I think politicians, this is why we need term limits, Maria, because until we have term limits and people understand they're going home, people are not going to touch the so-called third rail of politics, which is entitlements.
I'm really glad.
I got a 10%. My Social Security check last month, mine alone, not Elaine's, was $3,500. This is crazy.
Yeah.
That was 3/4 of what my starting pay was when I went to work 65 years ago.
But look what you and
That's how
Elaine are
out of
doing.
control
You're
this
giving
thing
it all
is.
away. You're giving it to NYU Langone Medical Center. You're giving it to the arts. You're giving it to cancer research. You're giving it to
Nice.
animal hospitals. You're giving your money away. You don't see that all the time, but you're doing it. And I'm glad you brought up term limits, Ken. We've spoken about this in the past. How is it possible that a
Many
politician
times.
goes to Washington and ends up spending 40, 50 years? They forget who they're working for. And I want you to know that I spoke with West Virginia Senator Joe Manchin on the phone the other day. He came on the show, and before he came on, I talked to him on the phone, and he said to me, you know what,
A
Maria?
very good friend of mine, Maria.
And he said to me, people are not going to like what I'm going to say, but you know what? I'm for term limits. And I said, wow, Ken Langone told me the same thing. He wants term limits. You even have a sitting Senator, Joe Manchin, calling for term limits. But the people who are going to decide this are the very people who are going to get impacted. So I don't see it happening, Ken. What about you?
Well, I don't see it happening, Maria, unless the American people get so fed up. I mean, we need by the way, Maria, with all due respect, thank you for your kind words about what Elaine and I are doing with our good fortune. But I'd be less than honest if I didn't say we're also keeping enough to live well, thank God. But really, we need term limits. I had an argument pushed at me last week. Two elected officials in Washington together said, well, you know, if you go to term limits, the staffs are going to run the government. I said, what the hell are you guys talking about? The staffs run the government now.
Right.
These guys haven't got the slightest idea what the hell they're doing.
Yeah.
And Maria, I'm serious. If and when the big crash comes, it is not going to be pretty.
Ugh.
It's not going to be pretty. And if we worry about China, we have to worry about China vis-a-vis a weakened American economy, a very weakened American economy.
That's right.
That's where you really run the risk.
So, Ken, real quick, we just talked to Larry McDonald. He said there's going to be a stock market crash within 60 days. He's talked to his institutional contacts to come up with that. But I want to get your take on market performance and what's priced in here. You're a big investor. If you expect we're going to see a recession, if you expect things are going to slow down quite a bit this year, does the stock market fall off, or is it priced in?
Maria, let me say this. I'm impervious to that argument for one reason. I'm a very long-term investor. My average holding, that's the weighted average of all my positions, is 41 years.
Wow.
I've owned my Lilly now, it'll be 45 years this November. Home Depot, of course, we founded it in 79. Yum Brands, 25 years. Parker Hannifin, one of the newer additions, 13, 14 years.
Okay.
Bad times come and bad times go. My advice to people is own great companies, great managements, strong balance sheets, a history of periodically raising dividends, and go fishing.
Yeah. I like the go fishing part.
And put money with Stan Drucken. By the way, put money with Stan Druckenmiller if you can. He's never had a losing year.
Wow.
And I've had the good fortune to be an investor of his since he had less than $1 million in assets.
That's pretty impressive.
But Maria, I'm not smart enough. These pundits that are saying we're going to have a crash in 60 and 9, they may be right, but they also may be wrong.
All right.
Don't bet against America.
Yeah.
My pitch on
Ooh.
investing, Maria.
Yeah.
Bet on America. We're the greatest country on earth. We always will be. We're going through a rough patch. We will get it right. Not without a lot of pain, but we'll get it right.
Amen
That's my
to that.
pitch, Maria.
Ken, it's great to see you. Thanks so much.
God bless you.
And
Say
to
hi
you.
to Jono, please, and have a great day.
I will. Thank
Bye-bye.
you, Ken.
All right, so let's add some commentary on that. Wow. Well, first of all, super admirable. The guy's donating his Social Security check. That's awesome. It's also really cool. I mean, I'm sure he donates more than that. He's got plenty of wealth. You know, there's really no need not to donate more than that at that point. But good for him. That's not to try to minimize what he's doing. But he makes two really good arguments. That number one, he amplifies how important it is to handle inflation, because if we don't handle inflation, then as he said, the little person gets screwed, especially the people living paycheck to paycheck. And that's why, as an investor, I hate to say it, but I'm purposefully trying to avoid investing where regular people are buying things right now. The Nike, the McDonald's, the Costco, the Staples, the Target, the Walmart, the restaurants. I'm trying to stay away from all of that. Let me put it this way. When you go to Cheesecake Factory or Red Robin Gourmet Burgers right now, you're eating at a charity because they lose money. They lose money. You sit down and eat, you make them lose more money. That's how bad costs have gotten at restaurants. If I really want to be exposed to staples, even like Home Depot or Lowe's, that are raising all of their employee wages, which is fantastic for them, but their costs have exploded so much. I don't think they can make any money here in the near term. Now, I love his argument about invest for the long term, invest in companies with great balance sheets, but my answer to that right now is pricing power stocks that appeal to the higher income business or consumer. Think about business. Businesses need servers. They need data centers. They need artificial intelligence. Invest, in my opinion, in those sorts of options. Look, I'm a licensed financial advisor. I can't give you personalized financial advice. I run an active ETF. You can learn more about it at meetkevin.com. I've got courses on building your wealth. You can now use buy now later platforms to pay for it. I don't recommend you do, but if you want to, you can. People have been asking for it. And yeah, we extended the coupon code to today because you can check out using that buy now later platform if you want. But the point is, I think you want pricing power stocks. And what you want to look for in the balance sheet is you want to look for companies with massive free cash flow. That is the opposite of what you're seeing at companies like a Coinbase right now or a Roku. These are cash burning businesses. Let me give you an example just by showing you Roku. And we do stuff like this in the course member live streams on almost a daily basis where we go through cash flow statements, balance sheets, you name it. Let me show you Roku, okay? So here's Roku. This is the balance sheet for Roku. What do we see on the balance sheet for Roku? Well, right now we see that they have negative free cash flow of 172. Actually, I did that math slightly wrong. It was actually 11. They have a negative cash flow of about $150 million. That's because they have a slight positive on operating activities, but they're only able to get this slight positive of almost $12 million here thanks to their purchases of plant, property, and equipment. So you've got a negative cash flowing business over here. And unfortunately, you've got a business that does have a net run of about, they've got about $1.1 billion in free cash available after their current liabilities. But when you consider that they're burning about 150 mil here, per quarter, and they're barely making money on the business, you go, okay, well, at some point they might have to raise money. Now, Roku a little bit more insulated than other businesses. For example, if we divide that, they've got about a 6-year run rate. That's not bad. Maybe Roku could end up going profitable. But then you have to ask yourself, do they actually have pricing power on their business? Well, they have a business that went from profitable in 2021 to income losing in 2022. They went from making $21 million to losing $250 million. That's because their SG&A, their sales, general, and administrative expenses basically doubled. Their R&D nearly doubled. At the same time, their revenue barely went up. You went from about $700 million in 2021 up about 4% to $731 million. Their devices revenue actually shrunk. Now their devices are loss leaders anyway because they want more subscription revenue. But the point is, on top of that, they're also seeing their costs explode. Their costs exploded 500 basis points. So their revenue is growing 4%. Their operating costs are doubling. Their margins are shrinking. And yeah, they've got a 6-year run rate because they made a lot of money during the boom market selling their stock. And that's fantastic. But is it actually a profitable business model? I don't know. It's not something I want to be exposed to. Now, look, when the Fed's money printers turn back on, everything's going to go back to the moon. So maybe it doesn't matter. Maybe it's unfair to bag on one company. But personally, I want to be looking at companies that have massive free cash flow. Very, very, very massive amount of free cash flow. That's what I care about. Big free cash flow. Big PP is what I call it. Pricing power stocks. So, look, that's just my opinion, right? Now, again, I want to be very clear. If you think that big recession is coming, like we just heard Ken, the co-founder of Home Depot, talk about, then you just don't want to be in stocks. But if you want to invest like Ken, then you look for high-quality companies that you think could be here for 40 years. Like he mentioned, his average hold is 40 years. That's That's admirable. Now, there are possibilities you could walk into value traps. For example, I think one that potentially is a value play right now is Intel. But Intel could be bankrupt in 5 years if their investment into new fabs fails. You know, they're exposing themselves to both the RISC architecture ARM and x86, which is fantastic. They're being very smart. They're basically becoming chip agnostic. We don't care what chip you want. We'll just make it for you, which is fantastic. Very, very smart. And with all the subsidies from the government for CHIPS Act, I can't see that going wrong. But that might be more risky than potentially investing. Well, I should say, just like Taiwan Semiconductors could be risky in the event there is some drama between China and Taiwan that extends. I think that's highly unlikely. I think it's very unlikely that China ends up invading Taiwan. I think that's Taiwan. I think that's their worst case scenario. But what American companies are probably here to stay, at least for now, for the long term. Probably your Teslas, your Apple, your Enphase, your Nvidia, your AMD. These are fantastic American companies that appeal to a higher net worth business or individual. And that, I think, is where you want to be positioned. That's just my take. And so I'm a big fan of pricing power style stocks like that. Learn more about, my courses and some of the other services that we do, like even the ETF, by going to meetkevin.com. Okay, well, anyway, basically, here's a Wall Street Journal article. I'll give you this sort of as a little bonus here. So I went through this Wall Street Journal article. It wasn't as great as I thought, but there were some fantastic arguments within it. Renovations now take 79 days on average longer than they did in 2019. They take an average of 79 days, up 259% from 2019. A lot of people are frustrated about how things are going over budget, how hard it is to find workers. People are becoming do-it-yourselfers out of necessity. Yeah, it was interesting. I mean, I like reading a lot, so sometimes I read stuff that isn't great. It's not worth, its own little video, but I thought I'd make a mention on it. So anyway, yeah, some thoughts here. I gotta go now. I gotta go to the course member live stream and get another cup of coffee from right behind me, and then I'll go to the course member live stream. So I'll see you in the next one. Thank you all so much for being here. It was a blast. A little tougher with the mobile studio, but I think we still did our best. Appreciate you all for being here. We'll see you soon. Bye, everyone.